You've been lied to. You've been told to invest in the stock market for the long run. The entire industry has convinced you that your hard-earned savings are actually investments, and that forces you to take imprudent risk with your savings. Everybody's basing this off of an amazing bull run, the largest in world history, on a 60-40 portfolio over the last few decades. Do you think that luck is going to continue into the future of your lifetime or even your grandchildren's lifetime? If we think about your hard-earned savings, you need those to grow, outpace inflation, and be there when you need them most, whether that's tomorrow or 100 years from now. So proper portfolio diversification will combine both offensive and defensive assets. As they say, offense wins games, but it's defense that wins championships. If we look at a 100-year history of the stock index, there's going to be multi-decade periods where the stock market's either flat or underwater. The primary issue, if we look at a long history of stock market returns, is the idea of sequencing risk. Your life is not going to line up perfectly with a stock market chart. What happens if another one of these underwater periods lasts 25 years, and maybe that's during your prime earning years from 40 to 65? Or you need your savings during one of these underwater periods because you have a family member with a medical emergency. Typically, you're recommended a diversified portfolio. But when they show you that pie chart of diversification, it's actually only half of the pie. They're only showing you diversification of offensive assets. They're showing you stocks, bonds, real estate or REITs, private equity, and venture capital, and they show that it's proper diversification. The issue is all of those are the same thing. They're offensive assets, and they do great when we're in a long GDP environment where the party's continuing to roll on, but as soon as markets sell off or there's a liquidity event, the correlations go to 1, meaning all of those asset classes go down together. We want to take that ensemble of offensive assets and combine it with an ensemble of defensive assets to build a holistic portfolio. When we think about assets on the defensive side, what we're talking about is long volatility, tail risk, commodity trend, gold, and Bitcoin to hedge some of that fiat risk as well. True diversification requires that a portfolio is able to thrive in all of the 4 economic environments. Those economic environments are on the axes of growth and inflation. If we think about a 4-quadrant model, you're either going to have growth, decline, or inflation and deflation. This idea of combining all of the 4 macro environments has a long intellectual history. It goes all the way back to the Talmud, where they recommended a third each in business, real estate, and cash. But the seminal work was really done in the 1970s by Harry Browne, when he created his permanent portfolio. He looked at the 4-quadrant model and he created his own portfolio that can manage growth, decline, inflation, and deflation. In each of those buckets, he included stocks, cash, gold, and bonds to manage the 4-quadrant model. If we use Harry Browne's 4-quadrant model, that was expanded on by Ray Dalio of Bridgewater fame, where he just used risk parity to lever up the bond side of that portfolio. Now we have more modern interpretations, whether it was Meb Faber's Trinity portfolio, or Chris Cole of Artemis Capital and his amazing paper on the Dragon portfolio. When we think about the 4-quadrant model and the way we apply it to the Cockroach portfolio, we use stocks for growth, volatility for decline to make sure we can capitalize on those market sell-offs. We use trend for inflation, and by trend we mean commodity trend following strategies that help us ride the rise in prices of commodities during an inflationary environment. And for deflation, we use income, which is similar to bonds or bond-like instruments. Where we think we've really improved on this 4-quadrant model is we like to use an ensemble of diversifiers within each bucket. We view that this ensemble approach allows us to get more robust returns from each strategy while also reducing the overall portfolio drawdowns. Outside of financial markets, another destroyer of wealth is massive devaluation of your fiat currency due to war or confiscation. So what we decided to do as a foundation to our portfolio is to carve out 20% of our collateral to purchase segregated gold and Bitcoin, which is no one else's liability and allows us to hedge some of those exogenous risks. That way we can manage that wealth during times of extreme stress. The other reason we believe in a layered ensemble approach to portfolio diversification is we believe that seeks to provide steadier returns while also lessening the drawdown over time. And those are the keys to really compounding your wealth over the next few years to the next 100 years. This is why we call it a cockroach portfolio. Granted, we know that's very visceral, but it's very alive and can sustain over any macroeconomic environment. And that's what we think about We want this portfolio to not only outlive you, but your grandchildren as well.